Tax attorney John Hyre here, and I'm going to walk you through, this is for real estate investors. I want to walk you through why investing through a Roth is much better than investing at a taxable rate. And this is really more oriented towards my flippers. I would have to do a different spreadsheet for landlords. And the reason is landlords oftentimes, at least in the beginning, aren't paying any tax. Still worthy of interest for those of you who are landlords and flippers, but this is especially for flippers. I want to show you the difference between investing taxable, namely at a 35% tax rate, versus investing tax-free. It's much bigger than you think. Investing tax-free through a Roth, whether it's a Roth IRA, a Roth 401k, a rollover business startup, a health savings account, a Coverdale educational savings account, you get very different results from making one change. So the investment's the same. Here's what I'm going to start with. You invest in one flip per year, just one. You start at 100,000, you make a 30% return. Now, if you don't like my numbers, take a look at the screen. The orange on the right, you can put in different numbers if you don't like mine. I'm just using these for illustration. If it's not illustrative for you, change it. So if you take a look at my spreadsheet, what am I comparing? Investing at 35% taxable rate versus investing at 0%. And just a spoiler alert, let's go to the third tab. If you invest tax-free for 20 years versus investing taxable for 20 years, and you start taking income for, let's say, 25 years, what's the difference? Well, if you invest taxable, your annual income is about 98,000. Let's round it up to 100. If you invest tax-free, take a look at column J, your income is over 500,000. So this is important. The difference between investing taxable versus tax-free over 20 years is that the income for the rest of your life under the tax-free method will be 5x what the income was in the beginning. And I think my assumptions are pretty modest. 100,000, not a large amount, a 30% return. I know some of you who do way better on flips, and that's before you even do things like introduce borrowing into the equation. So I think this is very doable. In fact, I have clients who regularly contribute 3, 4, 5, 600,000 per year to these retirement accounts. So I think this is a very modest example, but it makes an important point. After 20 years, your income tax-free is 5 times what it would be if you were investing at a 35% rate. And for a lot of you, a 35% rate is low. For example, if you're in California, federal income tax plus state income tax, max bracket's about 50%. Throw in some Social Security tax, self-employment tax, you're over 50%. So I'm not really trying to load this example. I can make the point, you make 5 times the income by investing the same money in the same way in a Roth. I can make that point without getting into nonsensical BS numbers. Let's walk through the spreadsheet. I want you to understand how I put it together. It's not that difficult, and I want you to be able to play with the spreadsheet. So we start, if you take a look at column C, line 7, so C7, you start at 100 grand. You flip once per year. You make 30,000, 30% return. Your taxes are 35%. So 35% of 30,000, 10,500. How much do you have at the very end? 100 plus 30 minus the taxes of 10,500. You have 119,500. In year 2, you start with the same number, 119,500, and you repeat. You invest at 30%. That makes you 35,850. You pay taxes at 35%. That's 12,548. And you're left with 142,803. Same logic when it comes to the Roth. You start with 100, you still make a 30% return, 30,000 in this case, but you're not paying the 35% tax. So you have 130 at the end of the year instead of 119.5. So beginning of year 2, you start with 130, you make your 30% on that, 39,000, you're left with 169, etc. Let's say you only do this for 10 years. 1 flip per year, 10 flips total, modest numbers. At the end of year 10, you have 594,000, rounding up a little. If it's Roth, you have 1.4 million. Big difference. And you're going to see what a big difference that makes in tab 2. In tab 2, you get kind of lazy for 10 years. Instead of flipping, you get tired of it, you decide it's too much work, you decide a 12% return. A nice 12% return, fairly passive. So take a look at my rate of return here in the orange box, and you can fill in your own numbers. If you don't like my orange box numbers, you think they're too low, you think they're too high, you're kind of curious, you want to play, fill in your own number. So you make a 12% passive return. Maybe you're doing some very light hard money lending, because 12% is a pretty light return for private money lending instead of flipping. It's easier, but you keep reinvesting it. So you started with your 593. We carried the balance over from tab 1. 12% on that is 71,000. 35% tax on that's 24,942. And if you think my tax rate is wrong again, there's the orange box. You can change it. And what do you have at the end of the year? 640,000. And so on, just like the prior one. If you're tax-free, it's simpler because we don't have the tax. You start with a much larger number, 1,378,575. It carries over from the prior tab. Your return on that at 12% is 165,430. Your cash balance at the end of the year, $1,544,015, and so on. So what happens? At the end of 20 years, you have how much? At the end of 20 years taxable, you have 1.2 million. Take a look at cell F16. Now take a look at the Roth cell, K16. You have, if you do this with a Roth, no tax, 4.2, almost 4.3 million. So then what happens? You invested for 20 years, 10 years in easy flips, 10 years in easy hard money. Now you're going to invest. I put here 25 years, but hey, I hope you live longer. And also, if you don't like my age that I put in there, you go back to the first tab and put in your own age there. I have 41. If you don't like that age, put in a different age. You do you. So going back to tab number 3, now you're going to just harvest. You've got this amount. In the case of taxable 1.2 million, take a look there at cell C7. And if you're tax-free, Roth, take a look at tab I7, cell I7, I should say, 4.3 million starting. So if you look at line 7, taxable, I start with 1.3 million. I make my 12% return, 151,000. I pay my 35% tax of 53,000. And every year I'm left with about 98,000. But if I did this with a Roth, same investment, same exact investment, the only thing we changed is where we're making the investment. I have 4.281 million. A 12% return on that is 513,000, almost 514,000, and I'm not taxed on it. So my annual income for having invested the same way, but in a different place, in a Roth, is 5 times what my income would be by investing in a taxable fashion. And you can look through the spreadsheet, you can play with it, you can challenge my assumptions, you can change the return rates, the tax rates. What do I want you to see? Investing in a Roth is superior to the point of 5x superior. And I used a modest example, just 100 grand. You can do it with way more. Now, is there a hassle? I can't touch the money. I have to keep them, which is what you're going to do anyway. Once you have enough money to live on, whatever that amount is for you, and you start investing, what do you typically do with the income from your investment? You invest it. You're not going to touch it anyway. The number one objection I get to these Roth accounts, I want to be able to touch the money anytime I want. Well, there's a price for that. You can do it. You can take the money out, but you're probably going to pay some tax on it. But if you think realistically, what do most real estate investors do once they're making enough, whatever that number is for you? What do they do when they invest? They reinvest. If you do it in a Roth, when you finally start to take the income, you're going to have 5x. 5x. That makes a big, big difference. Take a look at the 4th tab. I actually put in what is the discount rate. In other words, what's the net present value? I just like that as a tax guy, a math guy. I like to look at the net present value of things. What is the net present value of 98,000 starting 20 years from now, continuing for 25 years? If the discount rate is 8%. And if you don't like my discount rate, that's an orange box, you can change it. The net present value of that stream of payments at that point in time is about $1 million. Take a look at cell E5. What's the net present value of a stream of cash flow starting in 20 years, going for 25 years, of 514 per year? Well, net present value of that at an 8% discount rate is about 5.5 million. It's over 5x difference. Last but not least, at the very end, I included a little tab for the engineers, and that is the tab that says, don't overthink this. This is a simple spreadsheet. I love engineers who save our lives by building planes that have micromillimeter tolerances done right. That is an appropriate detail in that time and place. Nitpicking the living heck out of this spreadsheet with silly assumptions or immaterial numbers, which engineers are also known for doing, yeah, don't email me about that. Just wanted to make that point. So bottom line, Roth is way better. The proof is in the numbers. The numbers are right here. I hope you take the time to look at it, to play with it, and to act, to actually get into the Roth game, because a 5x difference in your income is a difference worth striving for. And Roth is the way. Thanks. Take care.